Something just broke in the silver market. Not cracked, not bent. Broke. Completely. Irreversibly. The kind of break that doesn't get fixed with a few phone calls and some creative accounting. The kind of break that rewrites the rules of global finance. Right now, physical silver is trading at $80.53 in Shanghai. The paper price in New York shows $71 or $80. That's a 9.27 premium on a single ounce of metal. $9. In the professional trading world, we don't call this a spread anymore. We call this a mathematical impossibility. We call this the moment when 50 years of financial engineering collides with the laws of physics. And physics always wins. The Shanghai Futures Exchange settlement data is public record. Contract AG2601 closed at Y18,145 per kilogram before their holiday break. Run the conversion yourself. Current USD CNY exchange rate, 7.306 kilograms to troy ounces, 32.15 ounces per kilo. The math screams at you. $80.53 per ounce. While the COMEX pretends silver is worth 71 over 80. This isn't a pricing error. This isn't a temporary holiday anomaly. This is the sound of the global arbitrage mechanism dying. The mechanism that has kept precious metals prices synchronized across continents for decades. The mechanism that Wall Street relies on to maintain control. The mechanism that just seized up like an engine without oil. Because the entity buying silver at $80 in Shanghai isn't some momentum-chasing hedge fund. It isn't cryptocurrency speculators looking for the next meme trade. It's the Chinese industrial complex. The factories that build solar panels. The companies manufacturing electric vehicle batteries. The supply chain managers who understand that silver isn't optional for their production lines. It's survival. And they've done the math on what's coming in 2026. They've seen the production schedules. They've analyzed the supply projections. They've realized something that makes $80 per ounce look like a bargain. There isn't enough silver on Earth for what they're planning to build. Here's what triggered the explosion. While you were planning Christmas dinner, two industries in China simultaneously realized they were facing supply extinction. The solar panel manufacturers and the electric vehicle sector, both hitting the same wall at the same time, both discovering that silver isn't optional, it's survival. The China Photovoltaic Industry Association released a report right before the holiday. Silver consumption per watt has stopped falling. They've hit what they call the thrifting wall. You cannot reduce the silver content any further without destroying the efficiency of the panel. And here's the kicker that Wall Street hasn't priced in. The industry is shifting to TOPCon technology. These new high-efficiency panels require 50% to 80% more silver than the old ones. So at the exact moment when global mine supply is flatlining, when every ounce matters, the Chinese solar industry just increased their consumption by nearly double. But solar panic is nothing compared to what's happening in the EV sector. Samsung just confirmed mass production timelines for solid-state batteries. 9-minute charge times, 600-mile range. Revolutionary technology, except there's one detail the headlines missed. The anode isn't made of graphite. It's made of a silver carbon composite. A standard EV uses 20 to 50 grams of silver for contacts and switches. A solid-state EV uses up to 1 kilogram, 1,000 grams. That's a 20 to 50 times increase in silver consumption per vehicle. Think about the implications. China makes more electric vehicles than the rest of the world combined. BYD, CATL, NIO. They're not going to let Samsung corner the market on next-generation battery technology. So what are they doing? They're strategic hoarding. They're buying the entire mine supply before it even comes out of the ground. When BYD secures silver, they don't buy 5,000 ounces. They buy 5 million ounces. And they are completely price inelastic. They don't care if it's $70 or $80 or to $90. They care about locking up the supply chain before their competitors realize what's happening. This creates a feedback loop that the paper markets cannot handle. Industrial buyers in China are bypassing traditional supply chains. They're going directly to the Shanghai exchange and taking delivery of 15-kilogram bars. They're melting down investment-grade silver to turn it into industrial paste. This is desperation buying. This is a sector that has looked at their 2026 production targets and realized they're facing famine. And the numbers prove it. Shanghai Futures Exchange warehouse stocks held over 3,000 tons of silver in 2021. As of December 23rd, they're down to less than 800 tons. A 75% drawdown in visible inventory. But registered warrants, the metal available for immediate delivery, is practically zero. This is why we have backwardation. The spot price trading higher than future prices. Factories are screaming, "Don't promise me metal in February. I don't believe you. Give me the metal today." This backwardation is the heartbeat of a squeeze. It's the market telling you there's a physical shortage at current price levels. Meanwhile, traders in New York are looking at charts. They're analyzing Fibonacci retracements and dollar index correlations. They have no idea what's happening on the ground in Jiangsu province. They think silver is a currency play. China knows silver is a strategic technology metal. The West is selling paper silver at $71 because they think it's expensive. The East is buying physical silver at $80 because they know it's cheap compared to shutting down a gigafactory. This is the great wealth transfer playing out in real time. Every ounce sold on the COMEX at $71 is being sucked up, refined, and shipped to Chinese warehouses where it will never be seen again. But here's the part that should terrify every professional trader watching this unfold. If there's a risk-free $9 profit on every ounce of silver, why isn't Wall Street closing this gap? These are the greediest, fastest, smartest institutions on Earth. They have supercomputers designed to scalp fractions of a penny in microseconds. If they see an asset trading at $71 in New York and $80 in Shanghai, their biological imperative is to close that spread. They should be buying every bar in the COMEX vaults, chartering cargo planes, flooding Shanghai with silver until the prices equalize. It's literally free money, risk-free arbitrage. So why is the gap getting wider? Why has it gone from $2 to $5 to $9? The answer is terrifyingly simple. They cannot move the metal. We are witnessing a catastrophic breakdown in the physical logistics of the silver market. The arbitrage mechanism that has kept global prices in sync for decades has seized up because the fuel is gone. You can trade paper contracts in milliseconds, but you cannot teleport a 1,000-ounce bar. You have to physically source it, load it, insure it, and fly it. And right now, that supply chain is broken. Sources in the logistics industry are reporting a complete blockade. Not that planes aren't flying. The metal isn't showing up at the loading dock. Bullion banks are calling vaults and refineries. For the first time in decades, they're being put on waiting lists, 6-week delays, 48 hours to locate specific bar serial numbers. In a digitized, modern vaulting system, you should know exactly where every bar is located down to the millimeter. When a vault operator tells you they need time to locate your metal, it means one thing. The metal isn't where it's supposed to be. Or worse, it's been rehypothecated, leased out to someone else, and they're scrambling to find a replacement before you notice. This brings us to the smoking gun. While everyone was distracted by holiday shopping, the COMEX released its inventory report for December 23rd. In a single day, the Asahi refining vault in New York saw a withdrawal of 1.4 million ounces from its registered category. Gone in 24 hours. JP Morgan's vault lost another 600,000 ounces. CNT lost 200,000 ounces, all in the same day. You're watching a bank run. You're watching smart money rushing for the exits. These entities are not playing the paper game. They're not hedging. They're taking physical possession. They're backing trucks up to loading docks in New York and driving away with millions of ounces. And this explains why the arbitrage gap won't close. The inventory that banks would use to ship to China is already being taken by the Chinese. It's a paradox. The very demand driving prices to $80 in Shanghai is also sucking inventory out of New York, making it impossible for banks to execute the arbitrage that would lower prices. It's a death spiral for the COMEX. The more the premium rises in Shanghai, the faster metal leaves New York. The faster metal leaves New York, the less liquidity there is to manage prices, and the less liquidity there is, the more prices disconnect. We're also hearing unverified reports from London floor traders that the LBMA is facing administrative delays in processing large-scale allocations. Usually, if you have an unallocated account and request your bars, it takes days. Reports suggest delays stretching into weeks. If London is out of metal, the game is over. London is the hub, the vault of last resort. If the London float is gone, then the COMEX is just an island trading derivatives of a ghost. This is why tomorrow morning is so dangerous. We have a market in New York that's been hollowed out, registered inventory plummeting to historic lows. The actual available metal is razor thin. And tomorrow the electronic markets turn back on for what traders call Ghost Week. Low volume, illiquid trading, skeleton crews running the desks. You have a $9 incentive for anyone with physical metal to sell it in Shanghai. But there's no metal left to ship. So what happens when you can't ship metal to close the gap? The only other variable that can move is price. The New York paper price must rise to meet reality. It cannot stay at $71 when the physical world is transacting at $80. The banks are trapped. They're short paper contracts in New York, but they've lost control of the physical inventory. They're like poker players who bet the house on a bluff, but the other player just showed a royal flush. The other player is China, and China isn't bluffing. They're taking the chips. They're taking the table. They're taking the metal. Tomorrow morning, when markets reopen, we're about to witness a collision between two unstoppable forces. The liquidity vacuum of Ghost Week and the price magnet of the $9 Shanghai premium. 90% of senior traders at major banks are on vacation. Trading desks are being run by junior traders and automated algorithms. On a normal day, there might be 500 contracts for sale at $71. 50. Tomorrow, there might be 50. This is the liquidity vacuum. It takes very little money to move the price a very long way. Now enter the high-frequency trading algorithms. These bots don't know it's Christmas. They don't know Asahi is empty. They only know math. And the math is screaming at them. Asset A in Shanghai, $80.53. Asset B in New York, $71.80. Instruction, buy asset B until price A equals price B. Usually a human would intervene, but the humans are skiing. The algorithms are running on autopilot. When Shanghai opens and confirms that $80 price, New York algorithms will try to close the gap the only way they know how, by bidding up the paper price. Here's how the squeeze happens. A Chinese industrial buyer places a large order. They don't care about the holiday. They need metal. This buy order hits the COMEX, but because it's Ghost Week, there are no sellers at $71.30. No sellers at $71.40. The order slips instantly to $72 just to fill the first contracts. HFT algorithms see the price jump. They calculate arbitrage opportunity and pile in. Suddenly, you have massive buying pressure hitting an empty room. The price doesn't tick up. It gaps. It skips $73. It skips $74. It prints $75 within minutes. This is an air pocket. Because physical arbitrage is broken, the only way to close the spread is for paper prices to teleport upward to meet physical reality. But it gets worse for the banks. There are thousands of call options at the $72 and $75 strikes. Banks sold these options to speculators. If prices gap to $75, banks are offside. Their automated risk engines have to buy futures to hedge losses. As prices rise, banks are forced to buy more to hedge. But buying more pushes prices higher, forcing them to buy more. It's a feedback loop from hell happening in a market with no inventory to slow it down. Who might sell at $75 to take profit? The miners aren't selling. They're holding back supply. The Chinese aren't selling. They're hoarding. The vaults are empty. The only potential sellers are retail traders. But are you going to sell silver at $75 when you know it is trading at $80 in China? The sellers go on strike. The buyers panic. The algorithms chase ghosts. If New York opens at $73 or higher tomorrow, the squeeze has begun. If we break $72.50 in the first hour, the air pocket is active. We could see a move to $78 before lunch. The market is trying to tell you something. The $71 price is a lie. The $80 price is the truth. And lies are about to be violently corrected. But here's what the mainstream analysts don't understand. Even if Ghost Week closes the gap and New York wakes up at $80, this isn't the end. This is the beginning. $80 isn't the ceiling. It's the new floor. What we're witnessing is the end of an era. The end of the Western discount. For 50 years, New York and London determined silver prices. They used paper contracts to keep prices convenient for Western banks. But today, with Shanghai trading at $80.53, that era is over. Pricing power has shifted east, and China isn't trying to manage prices. They're trying to secure metal. Once New York capitulates and matches the $80 price, the suppression mechanism is broken forever. To understand why prices go higher than $80, you have to understand industrial psychology. For 30 years, global industry ran on just-in-time inventory. You trusted the market. You trusted that if you clicked buy on Tuesday, metal would arrive on Wednesday. But what happens when premiums hit $9, when vaults run dry? Trust evaporates. We're moving from just-in-time to just-in-case. Every industrial CEO looking at this spread is thinking the same thing. If I don't buy 6 months of inventory right now, I might not get it later. This creates a hoarding supercycle. If you're building a $50,000 electric car that needs $80 worth of silver, you pay it. If silver goes to $150 and that car now needs $150 worth of silver, does that kill demand? No. It adds $70 to a $50,000 car. Irrelevant to the final product, but critical to its function, silver is inelastic. In an inelastic market, when confidence breaks, prices don't double. They add a zero. The paper masters built their entire game on one bluff. If you buy futures, we can deliver the metal. The $80 Shanghai price calls that bluff. If banks try to short silver at $80 to cap prices, arbitrage bots will buy their paper, take delivery, and ship it to China. Banks cannot suppress prices anymore because they'll bleed physical metal instantly. The artificial ceiling that kept silver below $30, then below $50, has been removed. We're entering pure price discovery. And in price discovery, prices have to rise high enough to either destroy demand or create supply. Solar and tech need silver. They can't switch. Demand is sticky. To create supply, it takes 10 years to permit and build new mines. Even if silver hits $200 tomorrow, no new supply is coming until 2035. For the next decade, price has to do the heavy lifting. $80 is just the wake-up call. $125 to $150 is the equilibrium needed to balance deficits. Right now, we have two prices, $71 and $80. By January, we'll have one price, $80 plus. Once that merger happens, Western investors will realize the shortage is real. They've been sitting on sidelines, afraid of bank smackdowns. When they see banks are powerless, when they see $80 holding support, investment capital will flood in. Industrial panic provides the floor. Logistics breakdown creates the squeeze. Investment FOMO becomes rocket fuel. This is the recipe for a move that makes 1980 look like a warm-up. But there's danger here. Not of price crashing, but of psychology. When silver hits $80, your brain will scream, it's too high. Sell, take profits. You're conditioned to think $30 is high. $50 is the top. You have to rewire your brain for the new reality. In a world where the dollar is dying and China pays $80 for strategic metal, $80 is cheap. $80 is the new $20. If you sell at $80, you're trading a scarce strategic asset for depreciating paper currency, right as the asset goes vertical. You're selling your lifeboat ticket as the ship starts sinking. Next week, volatility will be nauseating because liquidity is so thin. We might see flash crashes. Silver down $4 in a minute because some algorithm dumped futures. Media will scream, silver crash, bubble burst. Ignore it. Remember the Shanghai price. Remember industrial panic. If spot drops to $68 on your screen, ask yourself, can I actually buy physical metal at $68? Check online dealers, call local coin shops. They won't be lowering prices. They'll be raising premiums. They know the physical market is broken. We're rapidly approaching unobtainium. As the arbitrage gap widens, metal flow from west to east accelerates. Major US dealers are already running low on bars and coins. There's a real possibility that in January 2026, the buy button disappears, everything out of stock. 6 to 8 week delays. When that happens, screen prices become irrelevant. Doesn't matter if spot is $80 or $100 if you can't buy any. The strategy: if you have cash intended for silver, deploy it now. Don't try to time next week's dip. Don't try to save $5. Secure ounces while they're still available for immediate delivery. Once Ghost Week gaps hit and headlines break about $80 Shanghai prices, retail stampedes will clear remaining inventory in 48 hours. We are living through a historical pivot point. For 50 years, the Western financial system used paper derivatives to suppress real asset prices. They kept silver cheap to subsidize their industries and currencies. But the East has called the bluff. China, India, Russia, the BRICS are draining vaults. They're demanding physical delivery. They're forcing the world back to a system based on reality. The $9 premium explosion isn't a glitch. It's the sound of the old system breaking. The moment when paper promises collide with physical scarcity. The moment when industrial necessity overrides financial manipulation. Tomorrow morning, when Ghost Week begins, we're about to witness the most dangerous 48 hours in silver market history. Not dangerous because of what might happen. Dangerous because of what will happen when mathematics collides with holiday liquidity. Here's the battlefield. 90% of senior traders at JP Morgan, Goldman Sachs, and HSBC are on vacation. Aspen, the Hamptons. Their trading desks are being run by skeleton crews and automated algorithms. On a normal day, there might be 500 contracts for sale at $71.50. Tomorrow, there might be 50. This is the liquidity vacuum. It takes very little money to move the price a very long way. Now enter the high-frequency trading algorithms. These bots don't know it's Christmas. They don't know Asahi is empty. They only know math. And the math is screaming at them right now. Asset A in Shanghai, $80.53. Asset B in New York, $71.80. Instruction: buy asset B until price A equals price B. Usually a human would intervene. A human would say, wait, we can't ship the metal, so don't buy. But the humans are skiing. The algorithms are running on autopilot. When Shanghai opens and confirms that $80 price, New York algorithms will try to close the gap the only way they know how, by bidding up the paper price. Here's exactly how the squeeze unfolds, step by step. The trigger. A Chinese industrial buyer places a large order. They don't care about holidays. They need metal for January production schedules. The vacuum. This buy order hits the COMEX, but because it's Ghost Week, there are no sellers at $71.30, no sellers at $71.40. The order slips instantly to $72 just to fill the first few contracts. The algorithm chase. HFT bots see the price jump. They see the $9 premium. They calculate arbitrage opportunity and pile in. The air pocket. Suddenly, you have massive buying pressure hitting an empty room. The price doesn't tick up, it gaps. It skips $73. It skips $74. It prints $75 within minutes. And then comes gamma hell. Thousands of call options exist at the $72 and $75 strikes. Banks sold these options to speculators. When prices gap to $75, banks are losing money. Their automated risk engines have to buy futures to hedge. As prices rise, banks are forced to buy more. But buying more pushes prices higher, forcing them to buy even more. It's a feedback loop from hell, happening in a market with zero inventory to slow it down. But here's what nobody talks about. The silver market is tiny. Global annual mine supply is worth maybe $25 billion. That's smaller than the market cap of a single tech stock. But it's also the foundation of price discovery for all precious metals. If the silver market breaks, if Shanghai permanently trades at a premium to New York, then the entire precious metals complex becomes unreliable. Gold follows, platinum follows. The paper markets lose their authority. And when paper markets lose authority, real assets reprice violently. The $9 premium explosion is the canary in the coal mine. It's telling you that something fundamental has shifted in the relationship between East and West, between paper promises and physical reality, between financial engineering and industrial necessity. The squeeze is incoming not because speculators are pushing prices up. The squeeze is incoming because the Chinese industrial complex has looked at their 2026 production targets, calculated their silver requirements, and realized they have no choice. They must secure the metal now, at any price, or watch their factories shut down later. This isn't speculation. This isn't momentum trading. This is survival economics playing out in real time. Tomorrow morning, when Ghost Week begins, the collision becomes visible to everyone. The liquidity vacuum meets the price magnet. The broken arbitrage mechanism meets algorithmic buying pressure. The paper market meets physical reality, and reality always wins. The Shanghai premium just told you everything you need to know about what's coming. The only question is whether you will listen to the math or trust the mainstream narrative that everything is fine. The countdown has begun. The squeeze is incoming. The old system is breaking in real time. And once it breaks, there's no putting it back together.